Hi, everybody. I'm Jerry Kronenberg, Director of Financial Content here at Moomoo, and welcome to our third quarter earnings preview. I'm joined by two great guests today here in the studio. Justin Zacks, our Vice President of Strategy here at Moomoo, and joining us remotely, David Trainer of New Constructs, CEO of New Constructs, a firm that specializes in fundamental analysis using AI. Welcome, gentlemen. We certainly have an exciting period of time coming on in the market right now, but before we get started, I want to remind you this is a live chat. Please go ahead and answer and put your questions to David or Justin by the live chat. If you submit a question, you can look forward to 75 basis points added to your accounts, 75 bonus points. And if we use it on air, you can look to it at 150. So we're going to have a very exciting earnings season. It's already underway. We got some good bank earnings today. We've got Tesla and Netflix on tap for tomorrow. Let's go ahead and get right in it. We've got a big earnings season with a lot of instability and questions in the market, which we'll talk about. Oil, the Fed, and more. Let's get right into it. Let's start with some questions that our readers submitted before this chat got going. First one will be for Justin. Justin, welcome.
Thank you. Thanks for having me.
Great. Let's talk about reader question wants to know what sectors are you going to be watching closely this quarter?
So the first sector probably everyone's been watching the last few days is the big banks. We've seen almost all the big banks report already, and almost all of them have reported better than expected earnings. But I think the thing you really need to look at there is these are the banks that have the creme de la creme of the best customers. They don't take a lot of credit risk as much as the regional. So I really want to know how the regional banks are doing, and it really follows down to how the consumer was doing. Interesting comments out of the CEO of Bank of America, Brian Moynihan, in conjunction with the earnings, saying that the U.S. consumer is slowing at this point, but we haven't seen it out of the recent retail sales numbers this morning. So what I really want to watch are sectors that are levered to the consumer, consumer staples. Are they able to continue to place with the inflation? Are they continue able to pass that along? Procter & Gamble's coming up. If you look on our app, we have a great earnings calendar. You could see exactly which companies are coming up. Procter & Gamble's coming up tomorrow. Maker of Pampers, Crest, Gillette, and Tide. I want to hear what their view is of future inflation. And then in particular, retail stocks tend to report later in the cycle, a couple more weeks till we get most of their reports. But their biggest season's coming up. The holiday season is kind of going to be make or break for a lot of these retailers. So I want to know how the consumer's holding up with some of these retail stocks. And then obviously you have the quote big seven stocks, the tech or tech adjacent stocks, the biggest market cap ones. Everybody was going to want to know how they're doing. We get Tesla on Wednesday, and next week we're going to get four of the biggest ones: Microsoft, Alphabet, Meta, and Amazon. And really going to be watching to see how they're doing. They've outperformed the overall market by leaps and bounds this year. And will they come back down to earth, or will some of these other companies catch up? That's going to be the real question for me. Thank you for the question.
Thank you, David. What are you going to be looking at in the market for this earnings season?
I'm more interested in the basic materials, industrials, and energy companies. I think this is the new source of strength. I think we are very far overextended with the tech and AI and Tesla and NVIDIA and the popular names. I think this is sort of the dying part of the super mega bull market that's been fueled by excessive monetary and fiscal policy for over 2 decades. And so we're looking in other places. I think all the points just made are the that's what we've been focusing on for the last 10 or 20 years. And that's sort of what tends to move the market. Those are the stocks that set the beat for the rest of the market. But we like to look at other places. We think if you're following the crowd, it's much harder to make money. Like if you want to be a momentum FOMO trader, more power to you. We're looking more toward understanding fundamentals, long-term trends, and getting rich slowly, creating wealth carefully, productively, efficiently, intelligently, and not so much as the swing trading, going for the fences. I think when you talk about earnings, you have to be mindful of how much the bar, in terms of the expectations, gets manipulated in the weeks and months prior to the reporting. For a lot of the really popular stocks, you'll see the earnings estimates from Wall Street come down quietly behind the scenes so that that number that the company has to beat to surprise on the upside just gets lower, and the beats get easier and easier. We see this with Tesla. We see this with all the major tech stocks, popular stocks in general. And so I think people need to take sometimes a sideways view at this whole earnings game. It's a lot of propaganda to keep the markets frothy and to keep investors engaged.
Sounds good. David, do you follow Bank of America? We're getting a question about that earnings today. Is that stock you follow? Can I ask you a question about that?
Sure.
Okay, so we have a question from the audience. Is BAC likely to hit 29 or above this week? I don't know about this week, but maybe you have some thoughts about the stock, longer term, short term, what have you. What are your thoughts on that stock?
Yeah, great question. Unfortunately, we're not really in the business of short-term predictions. My crystal ball's in the shop, I like to say, on those kinds of things. But when we look at Bank of America, the underlying fundamentals look good. It gets an attractive rating on our system. We like how cheap it is. We like how the returns on capital for this business have been improving. The economic earnings have been improving. The free cash flow yield up at 5%. We've been saying for a while, JP Morgan is probably one of your better holdings in the entire market. We see that almost as better than an index fund like the S&P 500 because it's just a solid, hugely cash flowing business that has a lot of risk controls, good experience in place. And when you look at the S&P 500, there's a lot of crazy wild stocks in there that could cause that index to be more volatile than a big bank like JP Morgan. And Bank of America is not quite there, but they're getting there. And it's looking like a better and better business as time goes on, and they put some of the mistakes they've made in the past behind them.
Great. Well, we're getting a lot of questions. You're our fundamental analyst, so I'll give you two, and you can pick which one you want to answer. First one is looking at Tesla earnings. Basically, what do you think? And about Micron and what's going on with DRAM pricing. Do you have any thoughts on either of those stocks or those stocks?
Yeah. So look, whatever Tesla reports, it's nowhere close to what the company's got to do to justify the stock price. I've been saying this, I think, for 5 or 10 years. It falls mostly on deaf ears because I think we've got traders dominating the Tesla market, and look, you just the YouTube videos and the characters that are Tesla investors. I call them speculators or traders. Tesla is sort of the ultimate meme stock, and what people don't understand is the valuation has for so long been disconnected from fundamentals that people have now taken it for granted that it will remain disconnected from fundamentals. And by disconnected from fundamentals, I'm talking about simple math here. Tesla's got to sell close to 30 million cars annually, electric vehicles annually per year, right? By 2032 to justify its current stock price. That's at a margin equal to or better than Toyota, the highest margin business in car making of all time, right? They got to sell, guess, 30 million cars a year. Guess what the entire electric vehicle market is expected to be in 2032? Around 30 million, right? So the valuation of the stock implies they're going to have 100% market share or close to it, when we know that effectively to be impossible from an antitrust perspective, and impossible from a competitive perspective. We're seeing Tesla lose market share more and more rapidly with each passing month and quarter as more and more companies come online. So I don't really pay that much attention to earnings day to day, quarter to quarter, because I think there's too much noise there. With respect to Micron, I think the semiconductor industry is a big and growing industry. You need to be careful with respect to valuation. A lot of the valuations of these stocks have already run away from fundamentals. There are other pockets in the sector that make a lot more sense. They tend to be more of your picks and shovel type businesses, and that's where we recommend people focus. Move a little away from the headlines, because when everyone knows about it, you're late to the game. You're at best a FOMO trader or a Moomoo trader. And FOMO and Moomoo, you never know when the music's going to stop, and you're going to be left without a seat or without stock to sell at a reasonable price. And so we recommend digging a little deeper, finding those stocks that the market hasn't yet shined its light on and who have good fundamentals, and putting your investment there. We think that's a more intelligent allocation of capital than chasing the popular sexy names.
Well, that's great. Great answers there. Let's get one for Justin here. Oh, go ahead. Did you want to weigh in?
No.
Okay, so this is one we got before this session started, and it is a good one. With a recession on the table, what should we expect for 2024, the coming year? Justin, what's your take on that?
So I think a lot of people right now are really focused on the macro. They're focused on the geopolitical situation. They're focused on the Fed. And I kind of want to know how is that going to follow through to some of the companies in their earnings. And I think we can really read the tea leaves here in this earnings season looking forward, because they're going to give the outlooks for the next quarter, as well as a lot of the outlooks for the next year. And for the top line, thinking about revenue, a lot of these companies had revenue growth just based on inflation in nominal terms. Think about inflation at 6%. So if you grew your revenues at 6%, you're just keeping up with inflation. Next year, if inflation only runs 3 or 4%, you're going to have decelerating revenue growth. So assuming all things are equal. So you're going to see lower growth here just because inflation's coming down. I don't think a lot of people are thinking in those terms. And then getting on further down to the bottom line, I'm thinking about interest rates and the net interest expense of a lot of these companies. Right now, they still have borrowed. Their borrowings are still on their books. And so their net interest expense is not quite as big as you would think. But that won't last forever, because rates shot up so fast over the next year or two. Their interest expenses are going to balloon, and it's going to cut into margins. The other thing that will cut into margins is taxes. And over the last 10 years or so, we've seen a lot of the effective tax rates for so many companies go really far down. And a lot of these tax boondoggles are starting to roll off. So the tax rates will be higher. So those are the kind of things that I'm looking at for next year.
Great. David, you want to weigh in on that one? What are you looking at for 2024?
Yeah, I think those are great points. We have to be mindful of the fact that the cost of capital has gone way up. And we actually started a zombie stock list about a year and a half ago that listed those companies we felt like had a big risk of stocks going to zero and equity investors losing everything because they were burning cash like it was going out of style. And there was a lower and lower likelihood that they were going to be able to roll over the debt needed to finance this cash burning business. You can't waste money forever, even in the markets that have been as frothy as what we've seen over the last 20 years. And so I think, putting a finer point on the comments previously made about interest rates going up. Look, there are a lot of businesses that were in business only because of a super low cost of capital. If you could borrow at 2%, then your return on capital only needs to be 3%. And a 3% return on invested capital is enough to pay your debt bills when the debt bills are that cheap. But it's not really a competitive business in the broader scheme of things. And so when your cost of capital goes to 5% and you've got a 3% return on business, you're probably going out of business, or you may be able to sell equity to unsuspecting investors like a lot of the other meme stocks have, GameStop and Kohl's and a lot of these are costs and others and other kind of nutty stocks that go up for no reason. But that doesn't mean it's a smart investment. And I think we need to really be mindful. Bankruptcies are rising. I think they'll continue to rise. I think the Fed's plan has been to make this more of a gradual sort of squeeze and suffocation of bad businesses, flushing the system gradually and slowly, as opposed to a big sort of market crash and recession and flush. We know we can't do that again because it will just get people back on the buy the dip train, and we'll be back where we started in a short amount of time. So this is going to be a low, gradual squeeze or suffocation of bad businesses, whether it's because they can't pay their taxes or their debt bills. These businesses were really never that competitive, and they need to be effectively washed out of the system so that the capital with them can be recirculated back into healthy companies that create shareholder value. This is what makes the world go round. This is what makes the United States one of the best and most successful countries in the world. That's intelligent capital allocation, taking capital away from businesses that burn it, destroy it, or abuse it, and giving it to those companies that make real value, create real value, make smart investments. That's intelligent capital allocation. That's how you improve standards of living. That's where we'd like to put our money in investing. And we think there needs to be a big washout because way too many companies, whether it's Kava or Birkenstock recently, or Beyond Meat, or Robinhood, or Peloton, those are some zombie stocks we've seen in the past. Carvana, there's a lot of them. Sweet Green, those businesses need to be put down so that that capital can be reallocated to businesses that actually create value.
That's great. David, we're getting a number of questions on the video. One is just, I think, asking about earnings. The other one is asking, and it appears to be dropping today. Do you have any thoughts on in the video?
Yeah, I mean, we've done a couple of what we call reverse discounted cash flow case studies on NVIDIA, where we show people just exactly how expensive it is. Last time we did it, I think we showed that the stock price implied that their margins were going to be 50% better. That's 50. So I think they had to go from 30 to 45%, something already high to really high. I don't remember the exact numbers, but you can see the reverse DCF case study on our YouTube channel. But while also improving margins, the company had to grow revenues at something like 30% compounded annually for over a decade, right? So before, when I talked about how expensive Tesla was, same is true with NVIDIA. This is a valuation that has gotten wholly disconnected from fundamentals. So are we surprised to see the stock falling? Heck no. Is it going to fall a lot more probably over the next 6 to 12 months? Yes. When exactly will the price begin to reconcile to its fundamentals? I can't tell you exactly when that's going to happen. It can go up another 20% tomorrow. I don't know. What I do know is that the stock price is writing checks that the fundamentals can't cash, right? It's too expensive. And I would expect to see more and more downside. When exactly that manifests, I don't know. But you can see the math and walk through exactly how we perform our valuation analysis and multiple reverse DCF case studies on NVIDIA and a lot of other stocks.
That's excellent. That's excellent. And
I would just add to what David's saying. The video is also very supply constrained. You just can't stand up a semiconductor manufacturing facility in a couple months to meet the type of demand they have, and that's going to put a cap on the absolute revenue growth that they can have.
Right. That's right. It's like they've got a valuation that implies impossible production, right? Just like with Tesla. And that's where I think the math just gets abundantly obvious. It's like, okay, the valuation's implying they're going to sell, a certain number of chips or license a certain number of chips, that's beyond their capacity or any potential capacity that's realistic. Well, then, investors really need to take some pause. If you're an advisor, you really got to start to look yourself in the mirror and question whether or not you're fulfilling your fiduciary duty of care if you're going to consider putting clients into stocks that are that expensive.
Great. Next question for Justin, the Tesla question, and this is a good one, actually. I'm going to paraphrase. So we have the UAW strike ongoing. Is the biggest beneficiary going to be Tesla? What's your thoughts on that?
So they all obviously will benefit at some point because they're going to have a lower cost of labor. But Tesla has its own issues. It's already lowering prices to the point of really severely cutting into the margins. And back to David's point, you just can't look at Tesla and compare it to other automobile companies in a vacuum without looking at valuation. I mean, look at the valuation on the price to earnings multiple, or even forward price to earnings multiple. Any of these multiples compared to a Ford or a GM that trades at 5 multiple or something in that range, it's not even in the neighborhood. So it's very hard to make those types of comparisons. And ultimately, Tesla really will ultimately need to succeed on self-driving. They will need to succeed on the battery charging network. They will need to succeed on their software to grow into these types of valuations that you see now.
David, any thoughts?
Yeah, second everything that Justin said there. Look, Musk said it himself. If we can't do full self-driving, our stock is dead in the water. And I think they rank at the bottom of the pack with respect to autopilot and driver assistance. Look, there's all kinds of safety issues. Yeah, it's to me, it's sort of a ticking time bomb as to when there are probably a lot of legal and regulatory issues surrounding the whole Tesla and Musk situation. There are a lot of untoward and inappropriate things that have been said, misleading guidance, and you just wonder where the SEC's head is on all this, because there've been well documented and tracked issues. And they're going to have to develop. They're going to have to develop some sort of incredible self-driving technology or battery technology or something, because the car business cannot ever in its wildest dreams justify the expectations. And as far as we can tell, they continue to fall farther and farther behind with respect to full self-driving technology as well as battery technology. So whatever you want to believe about all the other businesses at Tesla being able to compensate for the extreme valuation of the auto business, we think that's building castles on sand and just hope on hope. And we would recommend investors, I guess, do a wake-up call and focus on fundamentals.
That's great advice. That's great advice. I'm going to add a moderator's comment here, which is I used to cover autos. I am not convinced that 20 years from now, everyone's going to be driving electric cars. When I get a plumber come up to my house saying how much he wants to get a Ford F-150 that's electric, then I'll believe it. Right now, I'm not believing that everyone in the world is going to be driving electric cars. I was starting to run short on time here. Got an excellent question here from before this started, and we'll start with Justin. All right, so fair question. How can companies beat on both the top and bottom line numbers and expectations during earnings seasons, and then they still go down or have a red day? What's your view on that?
Mainly two reasons. One is it's just a bad day for the stock market. You can't fight macroeconomic factors or sector factors that could drive a stock down. But more than likely it's because these analyst expectations, and David spoke a little bit about this before, and he probably can talk a lot about it at length. There is what the analysts think there is in this expectation, and then there's the quote whisper number, what the market thinks it is, and those whisper numbers for revenues and earnings are almost always higher than what the analysts think. And analysts are guided by companies who put out conservative guidance, so it goes all the way down. And so many times, just because a company beats by a few cents doesn't mean you can expect the stock to go up every time. It's something beginner traders definitely have to be aware of when you look at. You have to get much deeper into the balance sheet and the income statement to really figure out a company's prospects beyond just a headline number that can be manipulated.
I was going to ask you that, David. We got an even better question from the audience. All right. Is buying U.S. Treasury bond really zero risk? The yield just seems too good to be true. Any thoughts on that?
Yeah, that's the $30 trillion question these days. I would imagine it's hard for me to say no to that. I think that the United States continues to sort of wield enough power to make good on its debt, at least to the U.S. citizens. How much it's able to do that to some of its foreign investors, I think, is the big question. Look, you can't print money forever. You can't overspend forever. And we've been doing it for a long time. And it's starting to sort of feels like potentially spiral out of control as the deficit spending is accelerating and the debt issuance is having to keep up. Is there an infinite amount of demand for U.S. Treasuries? I don't think so. And how this all ends up playing out is really kind of a mystery to me. I think a lot of traditional economists have been scratching their head for a long time as to how so much profligate spending could continue to be afforded and accepted by markets. And I feel the same way. I don't know. It's always astonishing and upsetting to me to see what goes on in Capitol Hill. But I would say for now, for the foreseeable future, yes, I think we can trust the U.S. government to make good on its debt.
Well, great. Thanks to everybody for all their great questions. We're running out of time here, and I'd like to thank Justin Zacks of Moomoo and David Trainer of New Constructs for some great thoughts. For all the latest analysis, thoughts, news, community, and more about stocks, check out the Moomoo app 24/7. I'm Jerry Kronenberg. Thank you very much for watching.